Good morning and welcome back to the Broadcast Retirement Network. I'm Jeff Snyder and this is BRN Weekly for Saturday, August 8th, 2020. And our top story today, index funds continue to outperform their active counterparts during the pandemic. Joining me now to discuss this and more is A. So of S&P Dow Jones Indices. A, thanks so much for joining us on the program this morning.
Thank you for having me.
It's great to talk with you, and I really appreciate you and the team at S&P coming on from time to time. What I thought might make a really interesting conversation for the audience is to hear how active management and indices have performed over the last 4 months, because as you know, and we all know, there's been a lot of market turmoil. So what does your research, your and the firm's research suggest in this regard?
Absolutely, Jeff. Well, the last 6 months have been absolute roller coaster, especially the first 3 months, right? S&P 500 was down over 30%. We've had circuit breakers happening in the market. Volatility shot up, especially in the times of like heightened, risk aversion and heightened market volatility. In periods like that, we've heard claims that, actively managed strategies tend to do better than passive, because by owning the market you will go down along with the market. Well, that's one of the misconceptions that we always hear whenever there is market volatility. So we took a look at how actively managed funds have performed relative to indices especially in the last January through April, the 4 months. And what we found was, contrary to what people typically believe, actively managed funds actually struggle to outperform the benchmark. So, for example, over 64% of actively managed funds fail to beat S&P Composite 1500 index, which is the index representing large, mid, and small cap securities in the market. That's 64% in that 4 months alone. So again, and then when we look in the large cap, we found that 58% of actively managed large cap funds fail to outperform S&P 500. Again, the evidence is in the numbers. During periods of heightened volatility, it actually hurts active funds. That's what our study is showing.
Yeah, I mean, and that, as you mentioned, it runs counter to current or mainstream thinking. And obviously, you're paying an active manager, and I'm not trying to. I don't think we need to. We're not coming at a particular style of management, but I think when you're an investor, whether you're an institutional investor or a retail investor, you've got to take into account relative performance to an index, the fees, and a lot of other attributes when making your decision. Is that correct?
Absolutely. We often hear that, fees, play a role in performance drag. And we do find that to be the case in the case of fixed income. We also do research around what is the impact of fees on actively managed funds. We find that when it comes to equities, though, a lot of managers underperform even without, the fees drag on the performance. So that's something for investors to consider. The other thing that I would like for the end investor to consider is also risk and returns are two sides of the same coin, right? So we have to evaluate every investment or a decision to invest in an asset or in a fund from a risk-adjusted perspective. So on that front, we've done quite a lot of research on evaluating the performance of actively managed funds on risk-adjusted basis against indices, which are also risk adjusted. So when you put them on an equal footing like that, we also find that, even after adjusting for risk, a lot of active funds fail to outperform the benchmark. That's also another misconception that we're trying to dispel, because a lot of times managers claim that, they're able to manage risk better than indices. Well, again, that seems to not be the case. And all that research is available on our website at www.spindices.com.
When it comes to actual cash flows, any sense for whether individual investors and also institutional investors have gotten the message? And I would think that obviously with institutional investors, there's a lot of information handy that they can use in addition to looking at the Standard & Poor's website, the S&P Dow Jones Indices website. But is it your sense and the team's sense that more of these investors have gotten the message and are reallocating back towards indexes in certain categories?
I think, if we look at the trend over the last decade, especially that started since, 2008 financial crisis, right? There's been a structural change happening in the asset management industry where there's a migration of assets from active funds into passive funds. And that trend is continuing and it shows no signs of stopping. What it shows that, investors, whether they're retail or institutional, are waking up and seeing that, when you look at the performance, whether it's risk adjusted on an absolute basis, active funds have failed to live up to the passive counterparts of the benchmarks. So that's part of the reasons what's driving this migration of assets from active into passive. In the last 4 months, though, with the volatility, obviously there was a lot of risk aversion in among investors, and that risk of sentiment had led to major outflows from passive as well as active. Obviously, the outflows are greater in active than in passive. However, in the second quarter of this year, April through June, we're seeing investors coming back to reallocating the capital back into funds. They don't want to stay on the sideline anymore. So then there's greater flows going into passive funds than into active funds. So in some sense, I do think when we look at whether over a short time period or a longer term period, the migration of assets or the flows from active into passive is going to continue, but it's going to spell worse for active funds than for passive funds.
And lastly, when it comes to exchange traded funds or ETFs, we've certainly seen, I would imagine you have seen it, and the firm has seen a tremendous amount of cash flow going into ETFs. Would you expect that to grow at a greater rate given some of the research that we just discussed, the fact that active management has not performed well in these hyper volatile segments, with the cash flow going more towards passive? ETFs seem to be very popular these days.
Obviously, we're an index provider, and we do have ETFs linked to our indices. However, we don't recommend one investment wrapper over the other. But I do have to say that against that backdrop, ETFs have done a good job of democratizing the access to beta exposure for a lot of investors, especially passive exposure to beta, whether it's markets or sectors or particular factor exposure, what have you. So in that sense, ETFs have really disrupted the asset management industry and at a much low cost manner with transparency. So in that sense, investors are after these market-like returns with lower cost and with greater transparency. I do think the trend will continue and the disruption will continue. And so I don't think that the game is over yet. We'll see more.
Yeah, absolutely. Well, it's a pleasure talking with you. Thanks so much for joining us on the program this morning, and we look forward to having you back very soon. Thank you.
Thank you, Jeff. It's a pleasure. Thank you.
Thanks, Great to see you. And when we come back, we'll take a look at some of our best segments for the week. So stay tuned right here on BRN Weekly. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms, especially for the smaller businesses? I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network.
If you were like 58% of Americans, you didn't go to college. Or you did, but never finished. Maybe it's the thought of a big, intimidating campus. At Independence University, all classes are held online. Maybe it's the thought of being alone in a sea of students. At Independence U, you'll get a personal support team to help you every step of the way. Maybe it's the cost of all those books and supplies. Online means no books to buy. We even give you a new laptop and tablet to keep when you graduate. Maybe your life doesn't fit typical college classes. At Independence U, our online college fits your schedule. Let's meet a few students.
Independence University held my hand through the process.
Don't be afraid to take the leap because it has changed my life drastically.
Just take the first step and you can do it. If I did it, you can do it too.
At IU, there's no barriers to your degree.
800-535-9916.
Welcome back. On Wednesday, I spoke with the former Assistant Secretary of the Employee Benefit Security Administration, the Honorable Preston Rutledge, about the Employee Benefit Plan regulatory process. Let's take a look.
Well, yes, it is true. I have retired from federal service, but I haven't really retired. I do think there'll be a next chapter in the private sector. I'm happy to be back in the private sector, and it has been a really, really good career. I have been very fortunate to have been able to do all the things I've done, including getting to be the head of the Employee Benefit Security Administration at the Department of Labor. It was a great honor, and I appreciate it. I'm ready for the next chapter. Well, that's true. There are, and even the word regulatory has sort of I would say two major subdivisions. There's regulations, which are more formal and actually have done through the notice and comment process actually have the force and effect of law. Then there's the less formal. There's a lot of, we call that guidance. Just things that mean a lot to people in the industry. They want to know, people want to do things the right way. They really do, in my experience. But sometimes in a complicated statute like the Employee Retirement Income Security Act, ERISA, it's not always easy to know just what the right way to do things are. And so we often will help people through our guidance. And there's a number of different forms of less formal guidance that don't go through the Federal Register. They don't carry the force and effect of law, but they do tell the industry what the Department of Labor thinks is the best practice and the appropriate practice. And if you want to, follow those, you're probably very safe in knowing that you haven't committed an ERISA violation. That's correct. Basically, any employee benefit plan that's sponsored by a private employer is within the purview of the agency I was leading. That includes the health insurance, the health plans. So if an employer has an insured health plan, that's covered. If they have a self-funded health plan, that's covered. Disability, life insurance, all of the things like that, as well as retirement, which we know, defined contribution plans, defined benefit plans. Think of it this way: if you're receiving a benefit other than strictly your wages or your salary through your employer, it is almost certainly considered an employee benefit plan that in some way or another touches ERISA and the Department of Labor, and also probably the Department of Treasury too. The statute affects both taxes as well as your duties to operate the plans properly. in the interests of the participants. So you go to dol.gov, and if you want to do it in one quick step, it's dol.gov/EBSA,
Okay.
But if you just go to dol.gov, you'll see a drop down that says, oh, here are all the agencies, and you scroll down to the Employee Benefit Security Administration, click on that. And what you'll see is another menu. And the two to focus on there's a button to click on, it says Resources, and there's another button that says Laws and Regulations. So starting with the less formal, click on Resources, and you'll see another drop-down box, and it'll have things like advisory opinions, FAQs, which stands for frequently asked questions, information letters, things like that. There's actually a fairly extensive list. And those are the things where you'll find where the department is opined on what ERISA means in certain factual situations, and that's done so people will understand in commonly encountered situations what the Department of Labor thinks you should be doing. And those are published on our webpage. They don't go through the Federal Register, and that's a very good place to go. You scroll through, and you'll often see that the letter will be something that was requested by a particular company. It might be a representative like a law firm or a consulting firm asking on behalf of their clients generally, or it might be a particular company that wants to know about something for themselves. And so you might get advisory opinions for particular companies. You might get information letters that are more generally applicable. And it's also interesting, information letters, a lot of folks don't know this, an information letter can be issued by a regional office, not just the national office. And we have 13 regional offices around the country. Most of the folks that run employee benefit plans are aware of their local regional office. For example, if you're in Boston, there's a Boston regional office. And most folks know that if they live there. Advisory opinions can only be issued at the national office level, though. So there's a level of formality in that sense, but not in the sense that it goes to the Federal Register. Another important thing you won't see on the website, but people are aware of, and I'd like your viewers to be aware of, is one of the ways in which we get the word out sometimes, frankly, is through speeches. You know, we give speeches. I gave speeches. My deputy assistant secretaries gave speeches. Even folks in the folks in the regional offices give speeches, local speeches. Things we often will use those opportunities to communicate our views on things. Now, obviously, that's not a legally binding thing, but we don't want to say something in a speech and then turn around and do something else in an enforcement case. So we're very careful, but it's an interesting and frankly, I think a useful way to learn quickly what the department is thinking about, especially on a breaking issue, something that's a little fresher, that hasn't had enough time to be thoroughly analyzed, but you'd like to have an idea of what the department thinks. And then there's one other thing we do that's not well known. We particularly focus this effort on small employers around the country in smaller cities. We do seminars. There's an office within the Department of Labor's EBSA called Benefits Advisors. Those are the folks, by the way, if you call 1-800, EBSA help, there is this 1-800 number on our website. The person that answers that phone will be a benefits advisor who will give you advice, honestly. I mean, they actually are there to answer questions. It's not an enforcement person. It's not an investigator. It's someone there to help a participant who has a question about maybe their eligibility for a benefit. It might be a plan sponsor that has a question. I mean, believe me, it's interesting. We sometimes will get calls from people that are standing in an emergency room and they're being denied entrance and they thought their plan covered it. And so we will help them understand if their plan does, and we'll help them get that benefit covered. It's a very interesting office, but one of the things they do as well is they conduct seminars, about a dozen or so a year. We target different parts of the country every year, so we spread things around. And we focus on inviting small employers in that region to those seminars. And the general thrust of those seminars is to help medium-sized and small employers understand the duties they have when it comes to operating their health plans and their pension plans. It's usually 401ks, obviously, and it's usually an insured group health plan. but employers often just don't know what their obligations are. They're happy to do the right thing. Sometimes they just want to know what the right thing is that they should do.
And on Monday, I caught up with Janico Building Services Lorenzo Harris to talk about how employees were saving more in the Cal Savers plan. Let's take a look.
Well, Janico's doing well, surprisingly. Amid the COVID-19 pandemic, we were a little concerned initially that it might impact our business, but we're happy to report that the business is doing well. We've been from day one declared an essential business,
right?
And so we were able to continue to operate. We have lost some revenue due to office vacancies, more and people working from home, and so that did impact us somewhat. But that was counteracted by other customers who requested additional services. So
I'm sorry. Go ahead.
Balanced itself out. So again, surprisingly well, our staff, we were able to secure all of their jobs. We have not had to lay anyone off. In fact, we're hiring even more employees to fill the need or demand for our services. So yeah, our employees are doing well, and we're continuing to service our customers. Yes, as you know, Jeffrey, Janico was the first company in California to register for Cal Savers program, and we viewed it as a benefit to our company, despite the fact that it was a government mandate that all companies had to either provide, had to register, enroll their employees in Cal Savers, or provide their own private retirement plan. We viewed it as a benefit and as a win-win because it allowed our company, who previously did not offer a retirement savings plan for our employees because of the fiduciary responsibility and cost, we were able to provide this benefit as a facilitator of Cal Savers, which is administered by the state. Mm-hmm. And so the state took on that fiduciary responsibility, very minimal cost to us, and it's a benefit to our employees and allows them to save for their retirement. Where both pre and post COVID, we have seen very good response from our employees. We're currently, our employees are 70% of our employees are enrolled in the program. So it's we're getting very good participation rates, and that rate did not change even amidst the pandemic. So it's remained steady in terms of participation, and I would say the reason for that is partly due to job security. Again, we've not had to lay anyone off. We've assured our employees that their jobs are secure. We made sure that we implemented measures or additional measures to ensure their safety on the job. And so their participation in the plan has been steady. Exactly. The way the plan is structured, it's an automatic enrollment. So once an employer registers for the program, all of their employees are automatically enrolled. And so as an employer, our responsibility is to enroll the employees and to obviously to take payroll deductions and make the contributions to Cal Savers in their behalf. And because of the opt-out nature of the program versus opt-in, the research has shown that tends to increase the participation rates. Yes, I have had other businesses inquire with me about our experience with the program, and we have indicated to them that it's very easy to facilitate. The process to register is very simple. The platform, software platform is very intuitive. And so it's been a very good experience for us, and we have relayed that to other companies who've inquired.
And that wraps up this episode of BRN Weekly. But as you know, we're not done for the week, because tomorrow we've got our weekly podcast, BRN Sunday. I'll be joined by members of the media, academia, and financial services as we analyze all the news in retirement, markets, technology, personal finance, and more for the week. You're not going to want to miss this show. So until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.
Are you being audited, and do you owe the IRS $10,000 or more in back taxes? Is the IRS threatening to take more of your money? Don't fight the IRS alone. The Tax Doctor is here to help you negotiate your tax bill and reduce your stress. The IRS can freeze your assets and seize your bank accounts, but you can stop these IRS actions. The Tax Doctor will work with you using our years of experience to represent your case to help you get the best resolution under the IRS guidelines. Help is here to deal with the IRS to reduce your stress. We've handled thousands of cases, so we know what we're doing. If you owe $10,000 or more in back taxes, do not call the IRS alone. Call a Tax Doctor now for a tax emergency analysis.
Call 800-224-6439.